I put apps. So this business, I started with $267 and some change.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Welcome back to another episode of the Millionaires Unveiled podcast. This is episode number 278. Hope everybody's having a great week. I know I am. Market's been in a little bit of a upheaval, which has been interesting. We've got all sorts of things going on a global scale. Definitely going to be interesting to see how things continue to play out here into Q1. At any rate, this week we've got a returning guest. We have Dom. He was on episode number 80. Way back when, I believe it was 2019, when his net worth was just $1.1 million, and now his net worth is over $8 million. So I won't spoil it, but we'll get into the detail of how that grew so quickly and what he's done and whether or not his investment strategy has changed and some of the things that he's doing in his life now. So great episode coming up with him. Super excited. Last week we had Matt. He was a realtor after being in law enforcement and net worth of $1.1 million. If you're interested to be on the show, send us an email at millionairesunveiled@gmail.com. Still looking for that 300th episode. Hopefully we can get somebody on the podcast that's worth 300 plus. Always great to learn from those that have scaled their net worth to significant levels. At any rate, without any further delay, let's get into the interview with Dom.
Dom, what's the update, buddy?
A lot has happened in a relatively short period of time. Looking back, I mean, that's just a couple years ago. And since then, I started it and sold a significant portion of my business. And today, net worth is just over 8 million, quickly approaching my $10 million goal that I believe I shared on the episode we did, way back when in 2019.
Awesome. So sold a business. You get a big windfall. What are you doing with that money, or what have you done with that money at this point? Because your investment strategy completely changes to some degree, right?
Yeah, I mean, if you look at what I did prior to starting the business, I was very focused on, significantly increasing my income. I think I even shared on that first episode we did together that I believe that, the surest path to a high net worth was, a high income paired with a high savings rate. So I was very focused on the income side of the equation, looking to just continuously put all my energy and focus in increasing, income. And then at the same time, I was, spending or deploying a lot of that capital to pay off my mortgage. And I was investing, but I wasn't so focused on the investing side because I thought I would have significantly more upside if I could position myself to have a high income and eventually start a business and not have all the pressures of, worrying about a mortgage I had to pay or, all these fixed expenses. So what happens, once I start the business and, even pre-sale is, I don't have a mortgage, cash flow is significantly increasing even, from, my C-suite, comp package, which was, relatively high even back then. And I started deploying a lot more capital. My first focus was to set up an income stream. And I did a lot of that with, investing in real estate, probably from late 2019 through early 21, I probably deployed, almost $2 million into cash flowing real estate. Because my goal was to set up, about $250,000 in passive income. So if I decided, that I didn't want to work anymore, or the business, failed, or I wanted to sell early, and I didn't get as much as I thought I was going to get, that, that was going to be more than enough to support my family's lifestyle and still have, excess to continue investing. And then other things that I did, because again, the cash flow continued to increase, not just from the sale of the business, but also from the business itself, through comp and profit distribution. I started to invest in alternatives. I got exposure to private equity, other private businesses that weren't necessarily backed by private equity, but I had the opportunity to invest. I got exposure into crypto. I think that, kind of gives you a high level overview, but I'll pause there and see if that elicits, different rabbit holes that we want to go down.
Yeah. So let's rewind a little bit. When you're working in your C-suite job, at what point did you decide to pay off the house? And was that a priority versus deploying the cash into other real estate that was going to give you some cash flow?
Yeah, so I always have had a high degree of self-awareness, and I had three major goals in life, or maybe in terms of my professional life. And goal number one was to enter the corporate world, make my way up the corporate ladder to the C-suite by the time I was 30, and I was able to check that goal off. And then I also had a goal to eventually, start, scale, and sell a business. And so while I was in the C-suite, I used that cash flow there to start to mitigate risk to prepare me for the next chapter. You call it the entrepreneurship chapter if you want. And so the goal actually was set early on. This is back in 2015. I'd already had a goal to pay off the mortgage because I knew at some point I was going to find the right opportunity where, that stars align moment where the right opportunity, aligned with my skill set and my relationships, was going to give me that fat pitch that I had been preparing for about a decade, by the time I started my business, because I always had that itch to be an entrepreneur. And I've had lots of smaller entrepreneurial opportunities, but I knew at some point there was going to be a larger one on the horizon. So I did start paying off the mortgage, in as early as 2015. Set a goal to pay it off in 7 years. Ended up doing it, I think, just over 4 years. So I was mortgage free by mid 2018. Started the business in February of 2019. So that was always kind of part of the big plan. I would say one of my superpowers is being a super planner.
And at what point, what was your net worth at the time that you paid off your mortgage?
And actually I have it in front of me, so I'll tell you, it was sometime, I think, in May of 2018. So if I go back to May of 2018, my net worth back then was about $800,000.
Including the paid for home?
Yeah, that included the paid for home. So at the time, the value of the house, let's see here. Actually, the value of the house back then, just looking at my spreadsheet here, was, call it 400,000. We ended up selling it, by the way, just a couple months ago for about 720,000. So it definitely appreciated significantly since then.
So that really was kind of the main focus. Was getting that house paid for. That was a big chunk of your net worth, big chunk of your extra cash flow was going towards that. After that, then you started deploying into other real estate. And did you take on any debt for that real estate, or was it all paid for with cash? Paid for in cash.
And I actually wasn't, playing the residential real estate game, buying rentals that I was managing myself. Instead, I participated in syndications. So there's definitely sometimes debt used in some of the syndications that I participated in, but I wasn't personally taking on the debt. I'm a big believer, or at least for myself personally, in, extreme optionality. And debt wasn't going to give me the extreme optionality I was looking for. I didn't want to be in anyone else's debt to limit the options I would have, but also to add any kind of stress to me, because the reason that I ultimately wanted to have a paid off mortgage and really no debt to speak of to service is I didn't want to have any shackles to some payment that I had to make, and putting pressure on me to maybe do things in the eventual business that I knew I would start. That might not be in the interest of the long-term, success of that business, but in the short-term need to have to, service a mortgage or some other debt.
Interesting. So you're deploying money into these syndications. Where are you finding these syndications?
A couple different places. One that's more accessible to probably anyone listening to this call is CrowdStreet. So that's a good place, but then also private syndications. So over the years, I've built a lot of relationships, either through the blog that I've been writing for the last 8 years or so, GenYFinanceGuy.com, or just people that I've met. As you continue to grow your income and net worth and search for others that are like-minded and maybe even where you want to be. They start to open doors for you. So I got access to other sponsors that weren't listed on public crowdfunding sites like CrowdStreet. And so it's kind of a combination of private connections that I had and CrowdStreet kind of initially.
Okay. And what kind of return were you looking for when you're investing in those syndications?
So I was really looking for, my hurdle was a minimum, kind of 10%. And I should probably specify, I was looking for, kind of a cash yield of about 10%, but overall, a 15 to 20% IRR, if once you kind of include an exit at some point.
Okay. Put money in these syndications. A year later, you're getting into the point where you're about to go start this business. What was your net worth when you started the business?
So I officially hung my shingle up in February of 2019, and my net worth then was 1.1 million, which was around the same time you and I first chatted for the initial interview we did.
Yep. So 1.1, house is paid for. You've got a little bit of money coming in from some of these syndications, probably on a quarterly basis or an annual basis, I'm guessing, not necessarily monthly.
Yeah, and so a lot of the cash flow, and even in the investments in the syndications, I mean, it was smaller amounts, pre 2019. So yeah, there were quarterly. Mostly, I think most of it was quarterly. But now I have a pretty large mix of cash flow that's either coming monthly, quarterly, semi-annually. It all depends on the deal itself.
Okay, so you start this business, 1.1. Walk us through that first year. What was it like? Clients, income. How did you kind of start taking off? Because pretty soon that business exploded, right?
Yeah. So in February of 2019, I was actually still, in my role as a C-suite executive for my, employer at the time. So I kind of dipped my toes in the water. Like I knew I wanted to start a business, and I thought this business had, substantial, legs to turn into something much larger. But I wasn't ready to, go ahead and turn in my notice just yet. So, we started our first billable job in March of 2019. That February 2019 is just when I started as a sole proprietor before I eventually incorporated. But that's when I hung up my shingle. Billable work started in March 2019. And that first month, we did, only $3,000 in billable revenue, but we also didn't start the job until the 25th of March. And then if I think back, these are going to be round numbers. So, don't hold me to the exact amount here, but like April, we billed, 18 grand. And then May, it was like 24 grand. And then by June, we were billing, $30,000 to, $40,000 a month, somewhere in that range. And so by June, I kind of saw the writing on the wall that, this had not only the potential, or actually at that time, it was enough to replace my C-suite income, because most of this was margin. I had one co-founder that, he and I were doing all the billable work, but I owned the majority of the company. I did gift 25%, before we started, because I didn't know what this was going to turn into, but I wanted to also have, my co-founder have a substantial stake in the outcome if it was successful. So by June, I felt comfortable that this was not only, able to replace my current income, and also my current stock, kind of compensation that I had, but that it would be able to greatly exceed it. So that at that point in time, in June of 2019, I, drafted up my notice. And because I was so ingrained in the organization, I decided to give a 6-month notice, but I was going to be fully transparent that, I fully intended to run my company full time, but, give the company what they needed in terms of the critical things that needed my attention, but I wasn't going to be working full time. And, I got a call from the CEO, and, he was, a bit more emotional than I had expected, not in an aggressive, angry way, but in more like a father-son relationship, that he was kind of losing a son. And, basically, we left it as, he was very proud that I, had, his words, the balls to go out on my own. He's never met anyone that started in finance that had the balls to take the risk to be an entrepreneur. So now he looked at me as a peer, and he said, "Hey, I want to support you in any way that I can. If you promise to, at least make sure that you're transferring the critical, responsibilities that you have on your plate." He goes, I don't care. I know that you're running your business. I won't cut your compensation, and, I'll do everything I can. Even that means us eventually becoming a client to help support you in your new endeavor. So that's kind of what that first year looked like. My 6 months ended up turning into 8 months. I officially left that employer in February of 2020. The employer was also, allowed me to either choose to keep my equity in the business or to cash out. I decided, since I no longer had, an ability to be an influencer in that business, that I would cash out my equity. So at that point in time, that was about $500,000 that I was able to cash out. They were PE backed. Looking back, I probably left about $1 million on the table when they eventually transacted again. In late last year. But I made significantly more in both, terms of, cash flow from the business and my eventual sell in the business I started.
Wow, that's pretty amazing. So your former employer is telling you, "Hey, man, we're going to back you, essentially. You're going to work for us, but we know you're doing this. Like, hey, we're going to support you as much as possible." I mean, what did you do to get that kind of dynamic with, in that kind of environment? Because most people would probably be like, all right, dude, you're out. Like, we don't care. That's typically how corporate America works, right?
Yeah, well, I think there's a couple things. One is, I should have said, I started exploring this opportunity of creating, this business in summer of 2018. And I actually had contemplated potentially partnering with the CEO that I just mentioned and the private equity firm that was invested in, the firm that he founded. And, this was his second round with PE. But again, after my due diligence period and thinking long and hard of, do I really want to give up 80% of the upside for something that doesn't exist yet, something that was solely reliant on, my skill set, my relationships, and kind of the stars aligning because of, the preparation and the work that I put in, the prior decade. And in anticipation of this fat pitch that I knew would eventually, show itself. So I think just to add that level of context. But then the other thing, to answer your question more directly, that I think I did that allowed me to, get such a sweet deal in terms of, still having my full compensation for 8 months after I gave my notice, and really my time going down to, less than 20 hours a week, within 3 months of notice, and probably down to 10 hours a week after that, was first, the business that I started was actually centered around software that I had implemented for that employer back in 2014 when I first started with them, that had added incredible value. If you talk to that CEO, he would tell you that he would give me credit for adding 20% of EV because of the application I put in and the controls, and the ability for finance to transition itself as a strategic partner to partner with the business and its various stakeholders, to show them what levers they had to pull to increase top and bottom line results. I mean, when I joined the company, it was a $50 million business. When I left it, was a $250 million business, and profit margins back then were like 14% EBITDA margins, and by the time I left, they were 24%. So I enabled the organization to not only make the digital transformation to become data driven, leveraging really good technology, but I've left my fingerprints all over the organization, because it wasn't just finance. Like I spread my tentacles far and wide, and I went out there with a servant's heart to help people get what they wanted. It was always about, how could I help you help this business? And then I think all along the way, although I was compensated well and I got equity and options in the business, I always left money on the table, meaning I always asked for less than I knew I could probably get, because I wanted them to always feel like they got a good deal. And so by the time, I gave my notice in June of 2019, even though they were paying me full-time compensation, and I was working significantly less than the, 70 hours a week that I probably put in the, 6 years prior to giving my notice, they felt like they were still getting a good deal, that they still got some part of me that was plugged into their ecosystem. Which is why also eventually, come April 2020, they actually ended up hiring me, and I started to provide them, a service, after I left full-time employment there.
Interesting. So walk us through, how did you find this co-founder? What was the dynamic that you two, was he at a previous gig and you both jumped into this, or how did that all kind of work out?
Yeah, so my co-founder is actually about 10 years younger than me. So I'm 35. He's I think he just turned 26. So we're not quite 10 years apart, but somewhere between 9 and 10 years apart. And I've actually known this guy since, he was 3 years old. And you could call him like a brother. And when he was, 16, I was working in corporate America. He came to my wedding. He had expressed interest in, getting into finance, which is, kind of where I cut my teeth. And I told him at that point in time, I was like, look, by the time, you're ready and you're in college looking for an internship, if I'm in a position where I can give you an internship, I'll definitely give you that opportunity. And so, that was, kind of a conversation at 16. Eventually he graduates high school, goes to college. And he reaches back out to me, this is probably around 2015, 2016, saying, hey, I'm still interested in finance, and I'd love to take you up on your offer to get an internship if it's something that's in the cards. And at that time, I was a director of financial operations for the same company that I've talked about, being employed with prior to starting my own business. And that summer, got him an internship. Actually, had only planned on it being a summer internship and nothing more, but after a couple weeks, I realized that, he was a very talented individual, and the things that I had him doing And what I had witnessed just in the first 2 weeks, I realized that he was going to be just as good, if not better than me, and that I needed to keep him plugged in and with me wherever I go, whether I stayed employed at my previous employer or I went somewhere else. So fast forward, I let him stay employed with us even through college. So when he went back to school, he worked part-time. I gave him projects that didn't have, much time sensitivity. And he continued to develop his craft and his skill set, both, very, financially savvy and technically savvy. That's where, my magic zone is when you can, kind of overlap finance and technology savviness. And so when he was ready to graduate, I had, already made him a full-time offer to come work with me at my previous employer. But at the same time, I was talking to him about this business I was, looking to start. It was based off of, software that we were using on a daily basis at my previous employer. And you kind of painted the picture of, what if we could go, implement this at scale at many different companies and add the kind of value that we've done, here together. And he's like, well, wherever you go, I want to go. And that's kind of how that partnership was formed. And I knew I was going to need someone like him. He actually has, developed into be, not only surpassed my own skill set on the technical side of what we do, but he's just been an incredible partner, very, level-headed, and probably one of the best decisions I made when I started my business.
And does he live by you?
He actually lives in Texas and currently splits his time between Texas and Nevada.
Interesting. Okay, cool. So walk us through kind of the growth trajectory of the business, maybe some key points, and then get into when you decided to exit a little bit.
Yeah. So, year one, 2019, we ended up doing about $425,000 in fee revenue, running on about a 42% or 40% profit margin. I'd call it an EBITDA margin, but we didn't have much, ITDA in there. We were set up as an S corp, so everything was passed through to our personal tax returns. And really, it was really just my partner and I. We did bring on one full-time person in I think it was about September of 2019. So we had one employee at the time, and we had a couple contractors, people that were in my network. Then going into 2020, growth was accelerating. Yes, we had the pandemic start, and that got a little scary in terms of pipeline. But we still ended up growing significantly in 2020. We ended the year, we did about 1.5 million in revenue. We hired a couple more folks. And what I did when I started the business is I made a list of all my smartest, friends that also had, a ton of, finance and accounting experience that I thought would do well in this business, because I thought it would be really cool to build a business with my friends, to get rich and help them get rich in the process as well. So, I kept going after that list, and, the top 5 people that I had, on my list all ended up joining us at some point in time between, January 2020 and January of 2021. And then going into 2021, we had set a goal to not double the business, but to do about 2.2 million in top line. We ended the year with about 3.4 million in revenue, again delivering about a 42% profit margin. And so being in a consulting business, the profit margin is quite substantial. We didn't just do consulting; we also were a reseller. And I say we still are. It's just I don't own 100. We don't own 100% of the company anymore. But we're also a reseller, so there's commissions related to the software that we sell as well. And so I'm going to pause there. I don't want to ramble on, but want to make sure I'm staying on point to your question. That gives you a little bit of kind of growth trajectory.
Yeah. What were some unique turning points in that business, in that growth, or decisions you had to make that were pretty key to then allowing you to have an exit? Basically like 2 years after you start this business.
Yeah. So I think first and foremost, I think, one of the big mistakes that I think some entrepreneurs make if they, is that they start a business without having an exit in mind. I actually started this business fully intending to sell it. I had a goal to start, scale and sell the business in a relatively short period of time. I kind of initially put a 5-year target on that. But then as we continue to grow and we started to get, interested parties that, were reaching out to us unsolicited, I was already building, the infrastructure in the background to make a deal process very easy, whether we went private equity or strategic buyer. And so when those interested parties started to reach out to us in late 2020, early 21, I decided that, it might be, an opportunistic time to to consider selling a little earlier than I had, thought was possible. And, in doing so, some of the things that I think made our business, interesting to suitors. One is, we probably pre-collect, 80 to 90% of all of our fees up front before we ever do, any kind of work for a client. So cash flow becomes a non-issue. The faster we grow, the bigger the bank, or the cash balance is. So, essentially our clients were funding our growth. Think of Warren Buffett's strategy of, using insurance float. I essentially had a much smaller version of that where I was able to pre-collect and still pre-collect our fees to grow our business. I think the other thing is that, a lot of these types of consulting firms aren't good at demanding or at revenue, generating demand for revenue. But I had channels of acquisition in terms of, customers built in from day one, because the partner, the software, vendor that I partnered with, I essentially said, look, if I'm going to make this leap of faith, and go off my own, I need you to, provide, some consistent level of work. As of course we need to prove ourselves, and I don't expect you to keep sending us work if we don't do a good job. But, I got them to commit to when we first started, a couple jobs, and, we delivered those with 100% customer satisfaction rates. And we did it in far less time than even their internal services team were able to do. And that earned us, a good reputation on top of the one I already had as an evangelical client that said yes to every opportunity that they had come to me to do customer reference calls or speak to, venture capitalists when they were raising money, or private equity when they, got to that stage in their growth journey, to do webinars. So by the time, I was becoming a partner for them, I already had, a 6-year history with them, making a bet on them in their early days when they were a 50-person startup that, has grown substantially since then. And then on top of that, there was my own network, and the people that I was bringing in, they were already high level, finance executives that had a large network of folks that could potentially be clients. And being able to wear both the practitioner's lens of having, depth of experience in finance accounting, but also being technically savvy and having used a product like this to, bring efficiencies and improvements to a business, I think was a huge, value proposition and unique selling point for us versus any other consulting firm out there.
Were you investing in anything along the way, or did you put all your investment into this business? I put
this business, I started with $267 and some change, and my
was that just a filing fee?
Yeah, so that was for me to file a DBA, for the sole proprietorship. That's how we started before we incorporated, in August of 2019. And then I also bought, the domain name for the business that I set up for, setting up eventually a website. But everything beyond that $267, I promised, made a commitment to myself that the business would fund itself. It would, fund the growth. We wouldn't buy business cards until there was, cash flow to buy business cards. We wouldn't put up a website until we, had, taken enough, or made enough, to fund that website, and so on and so forth. So I never put another dollar in the business beyond that 267. And like I said earlier, our clients funded our growth because we were pre-collecting. I did take out a line of credit early on before I started the business because I didn't know that the industry standard was pre-collection. And so once I learned that, I never even had to use the line of credit that I had established on my primary residence before, leaving my previous employer. And in terms of, investing, so all the cash flow, I was mortgage free, right? I was paying myself, a couple $100,000 a year salary from the business. And then, I still, in the beginning, I still owned 75% of the business. So I was also, taking 75% of the profits in terms of profit distribution on a quarterly basis. So I had significant cash flow to deploy, and I didn't have to really keep much in the business. So I kept, deploying that elsewhere and diversifying that cash flow to build up, as I mentioned earlier, to build up that income stream of $250,000 a year. That was goal number one. And then goal number two was to start just planting as many seeds as I could that would, turn into eventual liquidity events somewhere down the road, some smaller and some, hopefully larger as they, germinate and turn into something, much bigger than when I invested.
That's awesome. So $267, that's all. I mean, start this business and it cash flowed and gave you basically the runway to accomplish all these other goals. That's awesome.
Yeah,
So
if you look at the numbers, sorry to interrupt, but like the $267, from start to sale, it took me 32 months, and I only sold 60% of the business, collectively between me and my partners. And that return, if you look at just the valuation, so we exited about a $7 million valuation, was about a compound annual growth rate of about 4,400% per year. But then if you look at the profit distribution of, we distributed almost $2 million in dividends, to myself and my, partners, which, that number grew over time. I ended up with 4 other partners besides my co-founder by the time we sold. So, that was over 32 months. That if you look at the total return, it was, almost 3.2 million %. I mean, it's kind of an astronomical number that's kind of mind blowing and kind of hard to realize. But, my personal value over 32 months, I was able to, create essentially $6 million out of an investment that rounds to zero.
So you get this big exit. What do? Do you go buy anything crazy? Do you do anything different in your personal investment life? Walk us through kind of that, the month prior to selling and the month after, or a couple months after.
Do I buy anything crazy? I wouldn't say it was crazy. I mean, I'm not a big spender, although I'm not also I'm not an extreme frugality person either. I'm more one that practices relative frugality. So I'd rather make $400,000 a year and spend $200,000 a year than make $40,000 and spend $20,000. Maybe I enjoy indulgences a bit more than the average person, but relative to our income, I've always spent significantly less than what we make. So in terms of crazy purchases, my celebration, after we closed the deal was to go buy a foil board, electronic foil board, to, kind of have a new hobby, because one of the things that I had planned to do, and I have done successfully since selling, a major stake in the business, is to take my working hours, down significantly. So, I only allocate 40 hours a week now. I know that probably sounds funny, but it feels like I work part-time. Having worked 70 to 80 hours a week for the last decade, it really does feel like I work part-time. And so I needed to pick up a new hobby. And so I bought that board. That was a, $15,000 purchase. And I actually bought 2, one for me, one for my father-in-law, so we could do something together. But other than that, like in terms of the amount of cash flow that, I generated from that sale, as well as, even the cash that was generated leading up to the sale, we didn't make very large purchases. We did over the course of, say 2020 through today, make, you can call it installment payments on our dream home. We actually ended up buying my in-laws' house that they had built 30 years ago out in wine country. So, pre-pandemic, right before the lockdown, we had decided that we wanted to buy this property after looking at others and, kind of planning with my in-laws in terms of what their plans were. We put 25% down. That was, back then it was about $385,000 in early 2020, right before the pandemic. And then we actually just moved into the house in December of 21. So you can call that a couple months after the sale. And we had decided once we sold our other house, not necessarily the proceeds from this, but we would pay off the mortgage here. And so because we assumed a small $400,000 mortgage on the property. So we paid that off. And then we've been, paying to have improvements. So like we plan to spend about $500,000 this year. That's $300,000 more than we've ever spent in any given year. But it's kind of one-time expenses to essentially turn this property into a resort that we never have to check out of.
And what does that entail?
So we're on 5 acres. The main house is 5,400 square feet, and there is a pool. So we're redoing the pool, adding jacuzzi, putting a full outdoor kitchen. I've added a cold plunge. We've got a little yoga studio. My wife loves yoga. I just installed a sauna. We're about to convert one of our bathrooms into a steam room shower to have kind of those spa amenities. And then, we have 2 garages that are, attached to the main house. And so the lower garage, I've actually converted, it's about 600 square feet that I converted into a gym and office area. And so this is just like the ultimate, entertainer's house, and the kind of resort style where we can, we don't really have to leave. We have a masseuse that comes every other week here to give us massages, and soon we'll have the pool and jacuzzi up and running. Right now it's drained as we work through the permitting process, so we can add a jacuzzi and outdoor kitchen. But yeah, that's that's kind of the goal right now. And we're hoping to have all these improvements done by the end of the year.
Sweet, man. I'm coming to visit.
Look me up.
Awesome. So at this point, you've had the exit. You know you've got basically a contractual obligation, and we don't get into all the details and whatnot. You're going to be doing this for a few more years. You've got a big goal to kind of be done at 40. What do you do with the cash that you have in terms of looking at your investments? Where are you deploying? Are you putting it in the market? Are you putting it into real estate? Are you going to put it into more small business? What's kind of the thought process there?
So it's kind of funny because when I first put together, back in 2015, I put together a 20-year plan to, at the time I had a $200,000 net worth and I wanted to get to a $10 million net worth by the time I was 48. And the way I envisioned getting there has been substantially different than how I actually got here. And what do I mean by that? I thought I would have 60% of my net worth in equities. I think I had, less than 5%, valuation coming from a business. And then I had, some allocation to cash and some allocation to real estate. Real estate might've been, 20 or so percent. That might not add up to 100%, but just vaguely, kind of going there. But what I've learned over time is that although I understand the equities market, and I also, I trade options and things like that, a larger majority or a majority of our net worth has been tied up in more illiquid investments, whether it's, from the equity of building a business or investing in real estate that isn't as easy as to transact. And I found that I actually look at, the lack of liquidity as a benefit versus, a defect, because it keeps me disciplined versus, the constant repricing of equities on a daily basis. With my type of personality, it makes me want to be more of a trader than I probably should be, because I'm not as smart as I may think I am. And so if you look at our, net worth, composition today, I'll kind of just give you a flavor for that. Of the total pie right now, about 30% is made up of business equity. That's the equity that I still have directly into the business that I own. I have one final payment coming later this year that will take that down, probably, to a less than 20%. And that's already kind of contractually obligated in terms of, how I negotiated the structure of my deal. And then I have another 20% that's tied up into my primary residence, another 20% in other, real estate. Some of that is, I've done several cannabis leaseback deals where we buy the commercial property and then, lease it back to cannabis companies on a 15-year triple net lease. They have to put substantial money into improvements to make it, ready for indoor cultivation. And these are all, cash deals, and you're looking at 18 to 25% cash on cash returns. I've done other, I've gotten into the hospitality space when those were kind of beaten down in the middle of the pandemic. I've gotten into larger, multifamily type deals as well. And then I've got a big bucket, 18%, you can round up to another 20% of, other alternative assets. And that's comprised of, investments in private businesses. I also have exposure to a private equity fund. I've got exposure to a big solar deal that I did this year that allowed me to essentially do a lot of tax planning for the income that I plan to generate this year, which will be almost north of $3 million for 2022. So it allowed me to not only get a really good return, but also to address a really big tax problem, because by investing in this, it allowed for substantial tax credits as well as bonus depreciation. And then I have about 5% allocated to crypto. I only got 3% in stocks, and then the rest is in cash.
Interesting. And do you plan to kind of keep that on a go forward basis? So
right now I'm in a process of kind of rebalancing as I continue to extract the turning equity into capital. I will continue to kind of diversify away from the business equity equation, except for as it'll balloon over time as long as we continue to grow the business. But I'm not going to I'm not trying to concentrate in any one area, but I do want to redeploy that capital. So like right now with a 3% stock allocation, I have some deals that I participated that I kind of put in the other alternatives bucket. Like I did a SPAC, right? And that's now gone public, and I'm going to get those shares sometime here in the next couple months. So that will move over to the stock bucket. In my real estate bucket, I had invested in a fund that was non-listed. It was a public non-listed public REIT. And that's now gone public, so that'll move into the stocks bucket. And I kind of have this vision where I kind of over time, probably not necessarily just selling assets to reallocate, but just using additional capital or liquidity events to balance it out. I like to get stocks probably up to like 10%, but I'm probably going to continue to focus on illiquid investments just because I think the trade-off you tend to get a higher return for the lack of liquidity. And like I said, you don't have this urge to over trade or over manage a position. It keeps you disciplined because you can't really trade in and out. You don't have the option. It's illiquid. So I'll probably continue to allocate to real estate and private investments, whether that's through private equity, venture capital, or directly into businesses that I get an opportunity to invest in.
Why have you not utilized a Roth IRA to invest in any of this? In these private business or illiquid businesses?
So I haven't used a Roth IRA. One is, my income's been too high to contribute to one directly. I could do the backdoor conversion. I've just been so busy. It's one of those things that's kind of been on the list to do a conversion. And I'm contemplating potentially doing it again this year, assuming it's still a viable option, because I think it was at some point on the table of potentially going away, and then using that money to do that. It's just one of those things where my income has been growing substantially, and it's another kind of tax liability to have to address, and it just hasn't been convenient for me to with all the tax planning that I've done to address the income without doing that conversion. But hey, it could be also maybe I don't know what I don't know, and maybe I'm missing an opportunity here. So open to you or your guests educating me.
Well, we can have a convo offline, but interesting. Well, Don, last words of advice for anybody who maybe wants to take that leap into entrepreneurship or just has an idea that they want to be in some more illiquid assets, because I think it's an interesting take, especially for our show, that you've got in being willing to be in a significant portion of your net worth in illiquid assets.
Yeah, well, I think the first thing is I still echo what I said back in 2019 when I did my first episode here. I still believe that a path to a high net worth or the most sure path is a high income paired with a high savings rate. I've been super focused on increasing income, whether that be through my career on the corporate side or through building a business. I've just been hypersensitive to growing an income. But in terms of whether you start a business or you go into liquid assets, I think you really need to pair that. Everything is a balance game, right? So yes, I have a leaning towards illiquid assets, but I make sure that I keep plenty of cash fund my daily life. I probably over allocate on cash. Like if you look at right now, I've got over $600,000 of cash sitting in the bank, and our burn rate outside of some of the improvements we're doing on the house is no more than $150,000 to $200,000 a year, depending on the year and what we're doing. So and the cash flow, we're still generating probably anywhere from $60,000 to $120,000 a month in income between our W-2 employment through my business that I now work for a larger company. My wife runs her own business but is on salary there, and we both still get profit distributions from our respective businesses. And then there's the passive income from those illiquid investments. So they might be liquid, but they also still provide cash flow. So even in a bad year, like if I look at next year, even if I stop working, we probably still have something, close to a 7-figure income, but just based off of our profit distribution and passive income alone. So that what's the takeaway there is, balance that, desire for illiquid assets to get the higher return, to keep disciplined with maintaining a high enough cash flow. Yes, there's an opportunity cost of keeping cash on the sidelines, especially with inflation where it is today. But again, you don't want to find yourself naked when the tide goes out, right? So I would say if you want to follow in my footsteps or you have the same kind of inclination, try to find that balance. And look, your balance might be different than mine. I have an aversion to debt, and so I tend to keep a higher cash balance. And then in terms of entrepreneurship, I've always been a big fan of having a side hustle that eventually might turn into your full-time hustle. You never know when a small stream might turn into an ocean of cash flow. And as you saw in the beginning of this interview, I talked about how I started this business while I was still gainfully employed and didn't make the jump until I knew that the cash flow was not only significant enough to offset my current income and kind of current comp package in terms of, the equity I had in my previous employer, but that I had a strong belief that it was going to significantly outpace my ability to earn and grow my family's net worth if I were to stay employed.
Yeah, that's awesome. That's Dom, net worth well over $8 million. Come on the show today.
No problem. Thank you so much for having me, and looking forward to connecting in the future.
All right, thanks, Dom.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.